few things that you can drill down into in a little more detail and then move forward and address in your own operations. So we're going to cover off a few topics here. We've got building wealth, protecting it, exiting your business, retirement income and estate planning. So we're covering a whole end-to-end of operating your business. So before we get into it, we'll quick general advice disclaimer, which all financial planning businesses need to do. So I don't know anyone's personal circumstances, so what I'm going to talk to is very general. If you need to get more personal information, come and talk to us or anyone else who's qualified. So business owner journey. Can I just get a show of hands in the room who are the principal in their business? Okay, and keep your hand up if there are more than one surveyor, consultant in your operation. Yeah, so most of you are operating in your own businesses, but as almost a sole operator. So that's just good context for me. Okay. So we're going to run through these topics. So we've got 5 sort of buckets, I suppose, of points to talk to. Jump in with any questions before we move through, or save it till the end, whatever suits. Okay, so one of the things we find fascinating as financial planners is that most people don't create a target for what it is they are trying to achieve financially. So in our business, we like to try and keep things simple, and it's about helping people identify what is that position in terms of my personal family assets, which allows me to choose to work or not work. At that point, it's then a lifestyle decision to continue to operate my business or to do anything. Right? So very important to have a target. So start with the end in mind. What is it I'm trying to achieve? So really simple numbers. I'm a simple sort of guy. If you want to operate a family budget of, say, $100,000 a year. So this is talking about we're going down the track into retirement. You've paid off debts, kids are educated, you finished work. This is just about your family continuing to live a lifestyle that you're excited about. So if you say, look, 120 grand a year, that's 10 grand a month, that's pretty good. About 80 grand a year is what the experts will tell you is a comfortable retirement. A little bit of overseas travel here and there, but nothing too extensive. So if you think, well, 120 grand, that's a fairly good number. Multiply that by 20, and you end up with a target for your retirement capital. 2.4 million will deliver 120,000 a year. For the future, you will never run out of money. You will never be reliant on an age pension. So a simple calculator. So while I'm going through this, think about it for yourselves. Go, okay, well, what's my target? Is it 100 grand a year? Is it 80? Is it 120? Is it 200? Doesn't matter. It's personal for everyone. Your own lifestyle is your own lifestyle. So setting a target is the most important thing at the outset. Time frame, less so important, but it's also in terms of realizing what the journey you've got ahead of you to say, I'm aiming for this target. Here I am now. This is how many years I've got to work with. Let's actually figure out how achievable that is. How much risk am I going to have to take to make that happen? Or what other options do I have to bring to the table? We'll talk about that later. So once you've got your target in mind, you're running your business, it's then we want to look at efficiency of how you receive income and how does that income, that surplus income, get out of your business activity into personal wealth. So for many of you running as a sole practitioner, your accountant may have brought to your attention whether you're operating in proprietary limited, a unit trust, other trust structure, or just as a sole trader, you've got some restrictions around how you can redirect income away from yourself and reduce tax. So business structures, often proprietary limiteds. You guys that are operating on your own proprietary limited structures, or are you sole traders? PT-wise? Yeah, okay. So the structures there, which is also good in terms of thinking down the track to exiting your business. It creates some flexibility as to how you might transition ownership. Are you looking to try and build an asset to sell? So we think about our target capital. Are we trying to build an asset that's a saleable asset, or am I just going to operate long enough to save enough money that I can just stop? I can hand over my relationships, and I can just shut the door. So thinking through to that point of what am I trying to build? Am I trying to build something that's saleable? If I'm trying to build something that's saleable, what are the sort of revenue sources that the market's going to like? There'll be some that'll be more attractive than others. So in terms of how you direct yourself over the course of running a business, it's important to think of it as am I trying to aim to a point where I'm selling, or am I just going to run a simple business and then just stop? Might be that a lot of you fit into I'm just going to run a business on my own without the headaches of staff and other consultants, and I'm just going to shut the door when I've hit my number. Like, perfect, nice and simple, but it's about knowing what is my plan. So business structure, all sorts of options there, but I think for the people in the room, it's a fairly simple. PTY Limited is probably your nice, clean option. You don't need to overcomplicate it. But tax effectiveness comes down to how do we pay tax on the money we earn? Once you earn more than 45 grand, you are paying a higher rate of tax than other structures offer you. So companies are only paying 28%, investment companies. Superannuation, you're paying 15% on the way in. So once you've hit 45 grand as an individual, you're already paying more tax than other options. So it's about looking at, how do I receive my money? How do I take advantage of the free kicks? Getting money into super at 15%. It's a bit of a no-brainer, but there's an access issue of when can I get my hands on that, and can I make it to that point, running my business, running my life, doing what I want to do. So tax effectiveness is really important. We know that inflation and tax are the two things that will consistently erode your wealth over time. So they're really important considerations as to how you receive money, how you efficiently get it through into your wealth generating entities. So final thing, which is probably a main challenge for a lot of people, is just managing personal expenses. As you earn more money, you tend to spend more. Lifestyle creep happens. You go on a nicer holiday, you buy a nicer car, you upgrade, renovate the house. All those things happen as you earn more money. So there is a saying that what you need to spend actually what dictates how much tax you pay. So what money you need to release into your own hands for spending is what drives your tax rate. But ultimately, if you've got a couple, if you think about it, if you've got a couple who are both generating PAYG income through company structures or through employment, then ultimately you've got quite a good base of income before you're paying too much tax. So it's just about managing, okay, what do I need to actually extract to pay off liabilities, educate kids, have a lifestyle, but also still save for a point in the future. So in terms of building wealth, this is the engine room, cash flow. Before I move on to the next thing, any particular questions around that, to business structure, being tax effective, on how you receive income? We're not in investing yet.
There's probably another element, and that's risk management.
Yep.
Most of us are in the litigation sort of space.
Yeah.
And there is a risk it's outside your control, but someone may sue you. So one, there's insurance, how you run your business, and there could be structures that need to be taken into consideration. The stop dead date, well, you can be sued after you retire. So you
of course.
get runoff insurance to ensure that. So those are
absolutely.
Some added little.
Yeah, absolutely. Yeah, so definitely making sure you're covering yourself, you're owning assets in a way that.
Sorry,
You're right.
just got to bring that up to you a bit.
Oh, right there. So yeah, definitely. Obviously, using PI insurance whilst you run your business is critical. As you say, run-off cover, how you own assets. So trying to avoid too much direct ownership of assets personally. So you end up in this thing. If you absolutely nail it, you don't own anything at the end of your life, but you control it all. So that flows through into, from an estate planning perspective, and we'll get to that. There's one thing to protect your assets, but then there's another thing around, well, what level of control do I have over my wealth now? So we see all the big end of town families in the news with arguments over family trusts and who's running what and who's in control. So things move from ownership to control. So it depends on how you do it. But that also helps to just cover yourself from any sort of attacks of a legal nature, definitely. So talking about protecting wealth, so we've kind of segued into this. So beyond your PI insurances, which is obviously covering that risk as a business operator, you've also got this gap. As you accumulate wealth, you've got a gap between your 2.4 number that I'll keep coming back to. So we've got a 2.4 million target of capital that we're trying to achieve in order to retire comfortably. So whilst I'm on my journey, the ability to earn income, the ability to build my assets is a key risk that needs to be covered. That is personal insurances, so life cover, income protection, those things, protecting your family's wealth position, what you're trying to achieve if something was to happen to you or any other breadwinner in the family. So insurances definitely are a key focus as you accumulate wealth. As you get closer to retirement, the cost of insurance gets astronomical personal insurances. So it's about bringing those down as efficiently as you can while still covering all your bases. So in terms of other areas, we've talked about super. So superannuation is a great place to protect wealth. It's a very favourable tax environment. Generally speaking, it's quite protected from external creditors. Not so much in a family law situation, but it's by far the best tax structure you've got available. And yes, while they're still talking about it, we'll always be talking about how they're going to generate more income from super, I firmly believe it will always be the most favourable tax environment. It might not be the 0% pension environment that we currently enjoy, but it'll definitely be better than the next option being family trusts, where you're going to ultimately be taxed in the worst case as an individual, but the best case you're still paying a company tax rate out of a family trust. So superannuation, really key aspect of long-term wealth and being effective. So if you think about our 2.4, at the moment each individual of a couple could have $2 million in super without being limited to add more. That money can continue to grow in there, but that's well and truly above the 2.4 that we need to generate 120 grand a year. So if you've nailed your ownership of assets, you could easily have all of your retirement capital sitting in a superannuation environment. And the superannuation environment is just a tax structure. It doesn't mean, people often think of super as the investment. It's just an ownership structure. What you do with that money is completely up to you. You could have a self-managed super fund, own property. Now, you guys with your skill sets, you may be more biased towards direct real estate as your investment assets, more so than maybe equities. So self-managed super allows you to do that. Doesn't mean that you're creating any different level of volatility or risk. It's just an ownership structure. So that's one that definitely needs to be, when you think about it as cascading money through a business, you've got personal tax rates. We can get, obviously pay zero tax on the first bit of money we get. Money into super, we're only paying 15%. That we want to fill that 30 grand a person bucket up as often as we can. The rules allow you to go back and pick up previous years, which is really effective. If you were to maybe sell an investment asset, we've got talk of capital gains changes in the budget at the moment. All these things come into play in terms of, well, how can I get more capital into a better environment? Definitely focus on using your free kicks, which are superannuation and tax rates, and they're very, very favourable. So family trusts are another classic part of a normal family wealth structure. So often people will have their proprietary limited business. If you're running a bigger business where you've got staff and you've got profit that can be channeled away from you, will often that profit, those shares will be held in a family trust, and the money goes out of the business, comes across into my family trust, and then depending on how much tax I've got to pay, that might then also go into a beneficiary company. So you might end up with these sort of different entities around your wealth creation, which is all keeping it away from you personally, protected from your activities, but also trying to make sure that we're not paying any more tax than 28 cents in the dollar, say it should be the highest tax rate your family group ever pays if you've got it right. And it's just about understanding, just with super, a family trust is a trust asset that you control, but you don't necessarily own. So, to many people's surprise, when they've done everything right, the accountants told them to do, I've got my super over here, I've got my family trust, I've got all this set up, and then they go sit down with the lawyer to do their will, and the lawyer goes, well, what assets have you got? The house is in your wife's name. Your super is not a estate asset in your will necessarily. My family trust is, you don't own that, so that's not a will asset. So, much to people's surprise, they go, I've accumulated all this money, but I don't actually have anything going into my will. Like, it's a bit of a light bulb moment, unless you've been ahead of that and you've seen it coming. So, when we look at asset ownership, personal ownership is obviously the last one, but it really is a least preferred option where you've got risk in your profession and you've got zero control over tax. So, owning assets personally really need to be just lifestyle assets that aren't necessarily there to generate. Might be a holiday home, it might be obviously your principal residence, and just making sure that ownership is set up in a way that continues to be efficient, continues to be protected from your activities around legal liability, but also keep in mind that there's this backstop of personal insurances as you accumulate your wealth that really do fill the bucket if something happened before you're ready to finish up your work and before you've achieved your retirement target. Any other questions on just protecting wealth in terms of ownership and how that flows through?
I've got a tax question with regard to death taxes on super. So because your money in super is not held within your estate, so that way it's assessable as a taxable component in a super that would be taxable in the event of death. For those that are over 60, is there a strategy to be able to reduce or avoid that tax?
Yeah, absolutely. So make a good point. So any super contribution that's gone in, that's a concessionally taxed one. So with money going to super, you've got a concessional one, which is your employer contribution, salary sacrifice, that type of thing. Those fit into a taxable bucket within your super account. Any money you've put in out of savings that is after tax goes into a non-concessional bucket, which is a tax-free bucket. So when you look at your statement for super, there'll be a breakdown of what's taxable and what's tax-free. So if a spouse receives your super benefit, they won't get taxed on it. But if an adult child who's not financially dependent gets it, the taxable component will get taxed. So there is a recontribution strategy where people, once they're over 60, will go, I'm going to take some money out, clean that money up, put it back in if I've got the limits available. So you can cycle that money through and end up sort of cleaning up all your taxable components, so it's not too nasty. Or, worst case scenario, if you have the opportunity before someone passes, is you just get them to take money out of super. So that's the other thing. If someone passes away unexpectedly, then that's it. But you can be proactive as long as you've got the limits available to cycle it back through. But the other thing as well, think about it if you're over 60, you've retired. Let's assume you've retired when you're thinking about these types of strategies. Well, then you don't have the taxable income coming through from work. So even if you didn't have the limits available, you can still invest quite a sizable amount of money and not have a tax problem. So people get obsessed with that rotation of money through. But once your business risk has stopped, you don't have risk of someone coming at you for your personal assets. Well, then you have some more options on the table. So then personal ownership is not that bad, as long as there's not too much of it. So the only other challenge, family trusts, personal, and capital gains tax is topical at the moment. It's it's like negative gearing, it's like superannuation. So what's being talked about at the moment, I don't think is going to be what will happen, but it's always going to be up for discussion. So superannuation is really your only place where once you're in retirement, you can freely shop and change assets, you can sell things without capital gains, you have got no barriers to keep reshuffling your portfolio if you want to. Whereas family trust, personal, you keep triggering capital gains, transaction costs, which then kind of frees you a little bit in terms of how you might change your assets and more ideally get them lined up to what you're wanting. So, but yeah, definitely some good strategies around how you take that tax expense out. So exiting business, I don't know that we need to spend much time on this. If the reality is, is anyone in the room building a business that they expect to sell for a capital sum at retirement? Yeah, so there's a few guys. So in terms of that, what are the ways you look to build your business that is an appealing target for an acquisition?
Brand recognition is one of the large things.
Yep. There's a particular type of work, type of revenue that's just really well favoured by the market in terms of getting the best return on your growth?
Having a spread, so you're not affected by the market.
Yep. So for you, it's a broad base, it's brand recognition, and effectively you've got. So would that be a sale of a business? Would it be a transition of ownership to other consultants? Not sure.
I'll worry about it. I'm 46, still got 20 years.
Worry about it later. Yeah. So definitely so thinking about through to if you're trying to build that business to a transition of ownership. So ownership structure is key in terms of how that might easily facilitate a change of control or a change of ownership or just straight out sale. For most people in the room, is going to be more like a transfer of relationships, handover of referral partners. Yep.
Yeah, mine is a built-in management buyout.
Yep.
So I've got someone working for me. The intention is that when he's ready and I'm ready, that we will, it'll be a management buyout on an agreement that we have.
Yeah, perfect. And so, but how big is your business separate to the two of you?
Well, there's only three of us in the
Yeah.
business,
Mm.
and it's more of continuity of what we are doing. Well,
Yeah.
Hopefully we're all getting better
Yeah.
at what we're doing.
Mm.
But the brand, as Stan says, you know, the company or the brand has recognition, and the quality of the work will continue. And
Yep.
therefore, there is a sustainable value there that's transitioning.
Mm. And that has a price. It has a value to it. So it's definitely. I don't think there's only a couple of you that this really applies to. So in terms of just thinking through the logic of how my business is going to change from me being in control and being a key person to how do I extract myself as a key person and still have an asset that's saleable and has value, that often takes time to do, and it's just a matter of giving it the conscious thought to map that through and to start to look for those relationships that then might take it forward for you. And it helps you then get in control of the timing as well. So definitely always best to think through from the get-go and to build a structure that is going to be appealing in that market. So understanding who the buyers might be, understanding what they're looking for, how they value it, and getting all of your ducks in a row compliance-wise, and so the business presents really well at that point. So area 4, retirement income. We want to just talk quickly about that investment mix. Let's talk about, keep coming back to our 2.4 million target. So we've got a couple trying to achieve 120 grand a year. We know that inflation and tax major eroders of our investment capital over time. So when you think about that point of relying completely on passive assets, it's a fairly big transition for people who have run their own businesses. Much easier if you've been an employed person. But so to feel comfortable to leap off that platform of being able to generate my income and to rely on the assets is a big change. So we think of it in these sort of layers. So I've got them here, 3 layers: liquidity reserves, income assets, and growth assets. So if you think about our 2.4, in our business, we would effectively say to someone, we want to have the first couple of years of your capital, we want that tucked away from market volatility, secure, protected. You know it's there. You can just enjoy your 120 grand a year without volatility and investment decision being too part of your thinking. We do come across people who are obsessed with having every dollar invested heavily, and it creates a lot of turmoil for them when it comes to releasing money, especially when you look at volatility that we've seen over this last little while with Liberation Day and now the Iran situation. So people get themselves in a bit of a tangle. So if you think about liquidity reserves being a couple of years of your 100, so 240 grand is going to be fairly boring, fairly defensive. Income assets, the next layer, another 240. So we've got 4 years of liquid assets that are really more just paying an income, like an enhanced income type style asset. So you know that's pumping out some good cash flow, and you know that your overall position, if we're taking 5% of our total capital each year, it's a fairly achievable outcome without having to touch a long-term capital base. That's what we're really trying to achieve. So growth assets, we really want that engine room to be fully invested, equities and property. Would you guys say that you're more inclined to buy direct real estate for your investment capital? Would that be more comfortable than equities or other types of investments? Yeah. So think about that across the range of property types. We've obviously got residential with a horribly low yield, certainly in Sydney. So if you're looking for retirement income, having a better mix of assets like industrial and commercial will then help to generate the sort of cash flow you need. You might also say, well, look, I get that if I had a more diverse set of assets, I might be able to get more income out of it. I might just push, and I might push for 2.53 million rather than 2.4 as my target. I know my assets aren't going to generate the sort of cash flow, but I'm going to be comfortable with them, and I'm not going to be able to interfere with them. All the research shows you that investors will take about 4% out of their return by making bad decisions at the wrong time. So if you're in liquid assets like shares, listed things where you can interfere with it and you can make a bad decision, there's a huge, we've seen it recently, gold's a great example, momentum of something. So gold, there is no way to value whether gold is expensive or cheap at the moment. It's a commodity, like all commodities. You can't value it based on a return on income. So that momentum of just people queuing up at the mint to buy gold just because it's had a phenomenal run, that momentum, that sentiment drives people to make really bad choices at really the wrong times. So I think it's great. Property is a great asset because property does well for a lot of people because you can't interfere with it. So people just buy their property and let it sit there, which is a perfect strategy. It's just about understanding liquidity and looking further down the track and saying, okay, well, I want to achieve a certain style of living in retirement, and I need to be a bit ahead of the curve if I'm going to be in lumpy assets as to when I'm going to release my money to be able to keep funding my cash flows and not ever be forced to sell an asset at a bad time. So how you set up your income, your retirement income mix is very important to, again, think further down the track. So as I said, $2 million in super each person. You could have $4 million in a super fund. You can have all your investment capital in a super fund and be paying zero tax if you want to. So it's about thinking through what are the sort of assets I want to hold and where am I best to hold them, and getting ahead of that way back in the process, not waiting till retirement and then going, right, so now I'm retired, how am I going to get this asset from there to there without costing myself a fortune? So definitely a key driver for us, and we do a lot of scenario planning in our work, which is to help people who are, a long way off retirement to see a bit further down the road and go, okay, well, if that's how it's going to look at that point, well, then maybe we should be doing some different things today and tomorrow to put ourselves in a better position where assets are held in the right places. Might feel counterintuitive at the moment, especially if you're a young person, you're still paying off a mortgage, and we're saying, well, yeah, but you are going to get that paid off, and if we start redirecting some tax-effective money into super, it's going to be a pretty good position. Doesn't feel like the right thing to do, but it is certainly a very effective wealth accumulation approach. So retirement income, again, thinking about the end in mind, thinking about the sort of assets you're comfortable with, mapping out what that's going to look like and how am I going to deploy my capital is really a key driver. You want to be confident in what you own at that point. You don't want to be thinking about where's my next dollar coming from. You want to see that through to a nice clear finish. So any questions on retirement income?
Is your 120,000 a year based on having no mortgage to pay?
Absolutely, yeah. So your 2.4, if you're going to use that sort of calculation, it's very simple, 20 times what I want to live on. It's got to be clear of your lifestyle assets. So it's investment capital, net of all debt. So that's a nice sort of clean number to work to, yeah.
And that's per person, right?
120,
Yeah, per person.
I'm saying 120 for a couple is probably a pretty good lifestyle. Yep, but that's on the basis of those numbers. You want to go for 240, then yeah, you do. Yeah, totally.
So another consideration might be with the skill set in the room.
Yeah.
Some of us might be more towards active property assets. So continuing to buy and build granny flats or dual locks, and live in one, rent out the other. Building up
Absolutely.
a property portfolio just to cash in on our skill set.
Yeah, absolutely.
Rather than passive unit trusts or whatever.
Absolutely. Yeah, no, I get the feeling that direct property would be the key asset class for you guys, so which makes perfect sense. And I agree. It's not only a great wealth builder, it's also a passion and interest that can continue once you're not working as well. So I think you do find people, and again, this is very much for people who run their own business. They get into retirement, they've shut the door on the business, handed over relationships, and then it's a massive change. So what is it that's going to keep your brain busy? What's going to keep you occupied? And those sort of projects, there's very much it's a wonderful format in terms of continuing to build your assets with quality products that you're building, but also keeps you engaged in what you're doing as well. But yeah, certainly the overall position of the damage people do in equities because of personal biases and the old fear and greed index is unbelievable. So we always find around these times of volatility, people are coming at it from just the wrong angle and often are making bad choices if left on to their own devices. So yeah, direct properties are much less less easy to interfere with if you're feeling a bit vulnerable. So it's good. Helps you protect yourself. Yeah.
So
Look, I don't think it'll have much impact. I mean, so the way that works, so it's $3 million per person.
Oh, per person.
Per person. So you got $3 million to start with. The 15% only relates to the portion of income that's generated off what's above the $3 million. So if you had $3,100,000 and your fund generated 5%, you're only paying that tax on 5% of the 100.
Oh, okay.
So it's
$4.50.
$4.50. Yeah, it's not a big impact. Where it's, where people have held, is it WiseTech, who's got a couple of $100 million in his super fund? They're the ones where, once you're above the 10 million threshold, then you start being taxed more heavily.
And that 3 million, is that going to be indexed?
Yeah.
Okay.
Yeah. So, I think the number of people who'll be affected by that very low, and the actual impact is going to be quite low also. Yeah. So that's the thing. I mean, if you go back to this time last year with the budget coming through, that was the hot topic, and what ended up going through is very different to what was on the table at this point. So hence we're not going to, people shouldn't be jumping at shadows around the CGT changes for investment properties, because who knows how it's actually going to come through, what's going to be supported into legislation. It's just could be very different. So don't be racing to sell. I mean, it seems that the property market's gone very quiet, so it doesn't seem like everyone's running for the door. So that's good. Any other questions on this part? Okay. There's a really, the last section, estate planning, I've touched on this as we've gone through, but really key thing to understand is if you've been effective and proactive in how you own assets and how you've built wealth, which might involve a family trust, might involve a lot of money in a super fund, it's just about understanding how that fits into your estate plan, so there's no surprises. And it might also just be a motivator to get something documented properly, which covers all the bases of my binding nomination. So your superannuation, effectively your binding nomination to your super fund can direct that money into your will if you wanted to go that way, or it can go direct to certain beneficiaries. So you can, certainly where if you've got split families, if there's questions over whether my will's going to be challenged, there are ways to get money quickly to key people who are spouses, ex-spouses, kids. You can get money straight to them, which isn't interfered with by probate or challenges to a will. So it's good to know that those options are there, but it's also good to know that if you don't make a nomination, then it's up to the trustees of your super fund what actually happens there. So it's a loose end, it's an admin that just needs to be tidied up so that everything happens as you wish. Similarly with family trusts. So family trust, very effective vehicle to own long-term family wealth, but also is more around control of the trustee than the ownership of the assets. So again, if you've had an effective, a proactive accountant and you've got money sitting in different entities, it's just thinking through how do the directorships, the shareholdings, the control of the wealth, how does it actually flow through to the people that I want it to flow through to in a way that's effective. So wills, critical part of an estate plan, obviously binding nominations from super, control of trusts, and then you've got your guardianship and powers of attorney. So those two are around making sure that lifestyle decisions can be made if you haven't got the capacity to make them yourself, but also financial decisions. So those sort of four elements, if you want to call it that, wills, binding nominations, enduring guardianship, enduring power of attorney, are really the key elements of a proper estate plan. You can have care directives and all sorts of end-of-life authorities as well. But having it, the more complex your situation gets, the more time you need to spend on just thinking through this as to how it actually works. If something happened tomorrow, what are the things? And it often becomes quite complicated once you've actually put money into trusts or super funds to a high degree. So yeah, definitely worth thinking through and worth implementing. It's probably the most consistent area of gaps for clients that come to us. Very rarely do people have an estate plan that's up to date, well considered, and properly documented. So it's a bit of an issue across the country, I think, in terms of financial management generally. So that was all I wanted to touch on there, and that's about the end of it for me. Any other questions or
Adam, for
comments?
those who prefer to manage their own investments, they feel confident with self-managed super and direct investment. Do you offer specific advice?
Absolutely, yeah. So we have a couple of hundred super funds that we look after. So from a strategic and an accounting compliance perspective, we provide that full service together as a coordinated package. Yeah. So yeah, property is the only thing that we're not experts in, that we can't provide advice on, of course. So we can't tell you what's a good property to buy, but you guys would know that more than me. Yeah. Any other questions? Oh.
Do you guys, or can you guys help with key man insurance? Discussing that.
Definitely can help with it. It's tricky. It's a tricky one to pin down, but yes, we can help with it. It's such a depends on your business and how you want it. Whether it's key man for buy-sell agreements or just key man generally for a business, we can definitely help. Okay.
Great, thank you, Adam.
All right. Thanks very much. Cheers. Oh.
Something for you all.
Oh, amazing. Thank you. Beautiful.